Welcome back, everyone. I'm Michael LeBlanc, Senior Portfolio Manager with LLC Private Wealth at CG Wealth Management, and this is Mike on Money Monthly Market Mistakes Edition. This month's mistake is blindly relying on index investing without understanding all the hidden risk. Most investors assume index investing is efficient, diversified, and rule-based. But what happens when those rules change? And more importantly, what happens when those rules force billions of dollars into a single stock, regardless of valuations? We're starting to see exactly that with some of these big mega companies out there. And at the core of this discussion is going to be SpaceX. But before we discuss SpaceX specifically, let's watch a short clip on indexing and concentration so that we're all understanding the key issues here. So let's watch.
Most investors think buying an index fund like the S&P 500 means automatic diversification. 500 companies spread across different sectors. Nice and balanced, right? But what if I told you your portfolio could actually depend on just 7 or 10 stocks? More than you ever realized? Here's the reality. Today, the top 10 companies in the S&P 500 make up roughly 40% of the entire index. So while broad index funds look diversified, in practice, they're increasingly concentrated bets on a few giant players. Most index funds are market cap weighted. The bigger the company, the more of your money flows automatically into it. When mega cap stocks outperform, their weight in the index rises. Index funds buy more, prices climb higher. This creates a feedback loop, concentrating both performance and risk. Here's the key issue many investors miss. Concentration works both ways. When these mega cap stocks rise, the index shines. But if they falter, the whole index can drop fast. Diversification breaks down. Correlation increases, meaning these big names can fall in tandem. At high concentration levels, your portfolio becomes tied to a single sector, in this case mainly technology, in the same economic or valuation risks. That isn't true diversification. That's hidden risk. We've seen this before. At the peak of the dot-com bubble in 2000, the largest companies dominated the index, only to underperform for years afterward. Today, concentration is even higher. History doesn't repeat exactly, but it can warn us of potential risk. Extreme concentration performance has never lasted permanently. So, what should investors actually do? First, understand what you own. Don't assume 500 stocks equals real diversification. Look at actual weightings. Next, diversify beyond broad indexes. Consider small and mid-cap allocations, and sector-specific indexes in international markets. The biggest mistake is confusing simplicity with safety. Passive investing is not risk-free, especially today, when just a few companies are driving everything. Make sure your portfolio is truly diversified, not just on paper.
So we see that a handful of stocks can seriously affect your diversification. Now let's discuss what happens when the rules suddenly change. New listing rules are being introduced to fast-track these mega IPOs directly into the major index, sometimes within days. For example, instead of waiting the traditional months before they're introduced into an index, a large company could now enter an index within as little as 5 to 15 trading days. Even more notably, minimum float requirements are being removed and index weights may be artificially boosted relative to the actual shares available for trading. And why does this matter? Well, index funds don't think, they just follow. When a company enters the index, and index ETFs are forced buyers, regardless of price or fundamentals. There's no research going into it. They're just buying the stock up until that weighting. So if a mega IPO is quickly added and at an inflated weight in, it can create an instant demand pressure that pushes those valuations up. And that's exactly what we've seen with SpaceX. This becomes a self-reinforcing cycle. In the case of SpaceX, a company with only about 4% of its shares publicly traded, because remember, a lot of the shares of SpaceX are still held by Elon Musk himself or by institutional investors. They could be treated as if there were more than three times that for the index weighting purposes. That disconnect creates a mismatch between a real supply and the forced demand, and that's where the risk really begins to build. So if we're having these modified and changing rules, there are two major implications here. First, this pulls liquidity away from the rest of the market. And second, it concentrates risk into a handful of names that are usually already heavily owned. Historically, these types of conditions often show up near market extremes, so near market highs. Um, so when we start bending these rules to accommodate these large issuers, it raises legitimate governance concerns. And with more IPOs on the way, like Anthropic being expected next, we'll continue to see these issues grow. Now, this doesn't mean the markets are about to turn tomorrow and crash, but it does highlight an important reality. Index investing is not as neutral as many believe. It can amplify trends, and in certain environments, it can also really amplify risk. So if your portfolio relies heavily on index exposures, it's worth taking a closer look at these structural changes and how they could be affecting you. In our ETF portfolios or any ETFs we use in any of our portfolios, we try to focus on sector specific tactical approach. So that we know how much weight we have in a particular sector or particular names, and we do that to avoid that over concentration when we don't want it, and limit correlation risk, because as we saw in our little video clip there, correlation risk goes up significantly if you have multiple ETFs that hold the same underlying weights and positions. If you'd like a second opinion, we're happy to help to review your current portfolios, or if you're thinking about investing in some of these different areas, feel free to reach out to us, call, email, go to Mike on Money for more information. With that, thank you for watching, and I'll see you next time on Mike on Money. Thank you.